One of the reasons I love playing in Excel so much is it gives me an organized way in which I can address problem solving for businesses that involve quantitative inputs that are used for decision-making outputs. The number one thing I always do is I start off by documenting assumptions. And whenever I do assumptions, I like to try to do them as orderly as possible. In this case, for example, I know that when we're going to deal with the WACC, we're going to deal with things such as equity, and we're going to deal with things such as debt. So that when we come across values, we can correspondingly place them into the columns for which they apply, and we'll use our rows then as descriptors or titles for them. So when I see the common stock has a beta of 0.9, I know immediately that that relates to an equity input. There is no debt relation, so if I want, I can go ahead and gray that out because it's not going to apply to that row title. The next thing that I see then, there's a treasury bill rate. We've discussed that historically the treasury bill rate is 4%, and that represents risk-free, which once again, that doesn't necessarily, I'm putting these on the right side, doesn't necessarily apply to the debt piece. The last thing that I see is the market risk premium, which I will abbreviate as being 0.08. A couple of you and I talked about this the other day, that the market risk premium is that formula inside the parentheses in the CAPM, which says it's the returns in the market minus risk-free. And the description of that is fairly straightforward. You get a premium, P, by taking on more risk, R, by investing in the market. So the MRP is 0.08. Then we see that we have capital structure. So let's call it capital structure, where 30% of their money is coming from debt, and that debt pays interest, or what we could think of as being the yield to maturity of 5%, and 70% of their money is coming from equity. These two things don't relate to the others, so we'll gray those out as well. And then the last thing we have is a tax rate, which we know then also applies to the debt. So the first thing that I always tackle is a structured methodology by which to organize my assumptions that I will then use to calculate outputs. So the first question then asks, what is their cost of capital? When we're talking about cost of capital, what we really are talking about is expected return, or the opportunity cost to shareholders. We will use then CAPM to calculate that. So for our CAPM, it's equals risk-free plus beta times that parenthetical reference in the formula, which is market returns minus risk-free. So now I have a cost of capital then of 11%. I always like to have 4 decimals when I'm dealing with rates. So I actually see it's 11.2% would be the cost that the shareholders would like. Now, one of the ways that you might want to work then with weighted average cost of capital is to go ahead and build yourself a little bit of a subtable over here, where we know that the formula basically says to weight it, first you need to know what that capital allocation is, or the capital structure is, and then you need to know the returns associated with it. So the capital allocation, we know, and we can go ahead, and if we want, I'll move this back over here so that I'll have the same headers. Equity is going to stay in column B, and debt will stay in column C. If we want, we can even just bring that down again. I'll just use equals references so that I don't have to type again. And I can put those here and here just to make it consistent. So the capital allocation we saw is up here. at 0.7 and 0.3 because I did such a nice job building this table out. Once I have one reference, I can go ahead and just copy and paste. The returns then for equity were the 11.2, and the returns for the debt were the 0.5. The capital asset pricing model goes into the returns. The yield to maturity goes into the debt. Then what we have to do is basically rate times weight. That's the way I think it. Rate times weight. So you could just call this, like a sub-calculation, or you don't even have to label it at all. Or you could do it all into one Excel cell if you wanted to. I like to break my work down sometimes so that I don't miss steps. Because if it's rate times weight, basically what that says, the fact that 70% of my money comes from shareholders who expect 11.2%, the weighted average cost of capital contribution to my total expectation from shareholders alone is about 7.8%. How does that then relate for the debt? The debt is 30% times the 0.05. So the debt holders demand standalone based off their weighting approximately 1.5%. But for the debt holders, we have to adjust that for the tax rate. So we'll adjust that times 1 minus tax. So the after-tax contribution to the weighted average cost of capital from the debt piece standalone is slightly less than 1%. If we put that all together then, it's really rate times weight, which is what we did above, and then you just add them up. So here's the rate times the weight for equity, plus the rate times the weight for the debt, and I get 8.74% as the answer for the weighted average cost of capital. So the last piece then asks if I have an IRR that is equal to 0.12, where I have a WACC then that is equal to 0.0874, would I accept or reject the project? Accept the project because its return is greater than the WACC.